Hello friends, this is Raj Sastry from Raj Option Trading. Today is July 19th, 2021. I want to talk about stock and option purchasing ideas for the week of July 19th. So with that, today we'll look at TTM Squeeze methodology from John Carter. So let's jump in and get started. What is TTM Squeeze? TTM Squeeze is a volatility indicator introduced by John Carter. It capitalizes on the tendency for price to break out strongly after consolidating in a tight range. Think about a scenario where you bought a stock but did not move for a couple of months and then you have to sell, but afterwards it moved. So it's a little bit, bad situation. So TTM skew will tell you when a stock is about to break out, so you can time your purchase accordingly, especially if you're a swing trader. So with that, let's jump in and see what is squeeze. So, you know, the quiet periods are identified when Bollinger Bands narrow in width to a point where they're actually inside the Keltner channels. So this marks the period of reduced volatility and signs the market is taking a significant breather, building up the steam for next move. So basically this quiet period is very important. You got to take some action during this quiet period because next there will be a big move up or down. And a trade signal occurs when Bollinger Bands move back outside the Kelton channel. So when they're in the Kelton channel, that's when it's a quiet period. When they're about to move out of the Kelton channel, that's when the breakout or the trade signal occurs. So the red dots in the TTM squeeze, they indicate tight compression of volatility, and first green dot after a series of red dot indicates the energy is ready to be released. So with that, let's jump in here. You can read through these slides. I'll be, you can look through this and freeze the session. But let's look at few stocks and go from there. So, these are the ideas for the week of June 19th. So I got few stocks here, starting with VALE. If you look at the VALE here, it's a $22 stock. And as you scan through this, they got a nice sales growth, both 1 year and the quarter over quarter, nice gross margin. And as you scan through here, we got a daily squeeze that tells you on a daily chart, there is a squeeze and right now energy is about to be released. And then we got Alcoa, ticker symbol AA, and I got price here $32. Also, good sales growth as you can see here, and I also have the volume here. Tells you, hey, is it good to either a lot of volume or liquidity? All these stocks have got nice liquidity. You don't need to worry too much about liquidity here. And this one has got a 1 week squeeze, a squeeze in a weekly chart, and this will last for a couple of weeks. Typically when you have a squeeze in a weekly chart, and then we got performance here, the 1 month, 3 month, 1 year, and how much it's off from 52-week high. So with that, let's look at a couple of examples. I've highlighted few in gray background here. Those are the ones we'll look at today because these typically tend to fire on the higher side or a bullish side. So with that, let's look at Alcoa here. Let me go back to Thinkorswim and I'll give Alcoa. So as we look at the Alcoa here, there is a squeeze on the weekly chart as we saw earlier. So I got the daily chart here, the 1 day, 1 year chart as you can see here. Then I got a 2 year, 3 day chart, and I have a weekly chart, 5 year weekly chart, and there is a monthly chart for 10 years. By looking at this and scanning through this, you know how the stock is doing in the longer term time frame, for example 10 year, and how it's doing in the shorter term time frame like 5 years, 2 years, and even 1 year. So typically in trading, it's always a good idea to trade in the direction of a longer term move. So with that, if you look at here, we got a squeeze forming over here in the 3 day chart, and as you see here, it's the A wave or the longer term C wave is above zero. That's a bullish sign per John Carter, and the shorter term A wave is below zero. We can actually ignore it and trade in the direction of the longer term C wave. And then we got a squeeze here formed in a 5-year weekly chart, a red dot indicating tight compression. At this time, Bollinger Band is within the Curtin channel, and as you can see here, the shorter term C wave is negative, but shorter term A wave is negative, but longer term C wave is positive and above zero. That tells you it's a bullish signal. So coast is clear for Alcoa for the longer term. So we have got a squeeze about to be formed in a 3-day chart as well as a weekly chart. With that, let's go into a different chart pattern here to see what's going on. So this is a Alcoa 1-day, 1-year chart, as you can see here, and nice looking chart. I love this chart here. They've been doing pretty okay. Now there's a temporary weakness, as you can see here in the shorter term time frame. And as you look through the volume here on the balance volume, of late it's down, as you can see here. That tells you more people are selling than buying. And as you scan through this here, RSI is pretty much 37. It tells you stock is oversold at this time. And DMI perspective, it's bearish. The red line is above blue line, and the distance is pretty pretty big here. So right now it's fairly in the bearish territory. And if you look at the historical volatility and IV, the implied volatility is down, as you can see here. This is what happens when the Bollinger Bands goes inside the Kelton channel. The volatility itself typically drops. As you see here, implied vol is 1.9. So right now it's very quiet. It has to release the energy either on the higher side or the lower side. And then if you look at the check-in money flow here, money is flowing out of the market. So smart money is really going out of the stock right now. So with that, by looking at this chart and glancing through, all the roads are indicating, what, this is a little bit bearish pattern. And, all the signals are telling you same thing. All the technical indicators, they're telling you, hey, be careful. Right now, there's a bear market. But John Carter's TTM Squeeze is telling you, hey, you know what? If you are a little longer term trader, you can be okay because the longer term C wave is above zero. So with this, let's take advantage and go to the trade. Go to the option chain here. And if you're a long-term stock trader, you could just buy some Alcoa at 32.85 and confirm and send. You'll pay around 3200, as you can see here. But if you are an option trader, you could trade, go a little bit longer term. I would say go 123 days out. And if you want to buy option outright, you could stick to Delta 70 options somewhere here. 71 is good. You could pay $6.25 and buy one contract, as you can see here, for Alcoa for 19th November 2021. Expiration date is the strike price is 29, as you can see here, which is below the current stock price. If you confirm and send this, you're buying this call option here, strike price 29, you're paying $6.25. And this is this will be profitable if Alcoa stock stays above $35.25. And for every move that Alcoa stock makes, the option will go up or down by 71 cents, as you can see here right now. And you could, if your max loss is the premium that you paid, which is $625. So this is one way to play. If you have a little bit larger account size, and if you know your options well, you could do something like this. But if you want to play a spread game, then you could do a little differently. Stock price being 32, you could do a couple things. You could do 25-35 spread. That could be one way to play, or even you could do 27 and 32 spread. So if you do 27-32 spread, so you could just buy spread 27 and 32, something like this. So if you do this, you could confirm and send here. You're actually paying your max loss is $300, and your max profit is $200. It's risk reward perspective. You're making some money, but not doubling the money. So what you could also do is you could increase your strike price a little longer. So for example, 27.32 will give you so much. You could do a little differently. You could buy. You could actually increase your spread a little bit. So for example, 27 and here instead of 32, you could go a little higher, maybe say 35. So if you do this, you are paying $4 and 20 cents, and as you see here, you're making 380. So this is one way to play. And if you do something like this, your break-even point is below the current stock price. As you can see here, current stock price is 32.95. Your break-even is below current stock price, and your max loss is 420. That's the amount that you're paying to buy the option here, and you're making 380. This is one way to play, and you could confirm and send. So if you don't want to spend too much capital into it, you could also do a 30-35 spread, just a $5 spread. So if you do 30-35 spread, you could buy this spread right here, 30-35. There you go. You are paying $2.38, and remaining portion of $5 is your profit potential. So as you can see here, you are paying 238 to make 262. This has got a little bit better risk reward. The break-even price is just below the current stock price. This is another way to play. Especially if you don't want to spend too much money into this optional play, you could just buy a $5 wide spread, and if the stock goes above 32.38 by the expiration date, you'll break even. Your max profit is 262, which is just more than doubling your money. So next, let's look at a couple more ideas. If we go back here, we got a couple more. I like many of these stocks. I love stocks like NextEra Energy. Coupang is also coming into buy territory right now. It's a great stock right now. It's off 24%. But for this indicator, let's look at EPD Enterprise Product Partners. It's again a good stock. If you look at EPD. First, let's go to John Carter's squeeze chart here. So as we look through the EPD here, we got a 1 day, 1 year, 1 day chart here. There is a compression here, red dot forming here. As you scan through, the A wave, shorter term A wave, it's below zero. Longer term C wave is above zero. And also as you scan through here, we got a dot or a squeeze about to be formed in a 2 day, 3 year chart. And as you scan through here, TTM, the A wave, shorter term A wave is barely above zero, and longer term C wave is squarely above zero. That's a positive indication. Looks like we got a squeeze forming in a weekly chart, and shorter term wave is above zero. Longer term A wave is trying to get above zero. As you can see, your bar is getting shorter and shorter. It's trying to get above zero. And looks like on the longer term there is nothing happening here, so we don't need to worry too much. So now let's go into a different chart pattern and see what's going on here. So this is a different chart pattern here. Nice looking chart. I love this chart for enterprise product partners. Pretty steady eddy stock. On the balance volume is pretty nice. I think it's right now it's trending down a little bit. And DMI perspective, right now there is a bearish crossover. As you can see here, the red line is crossing over the blue line, and implied vol is 15.5, IV rank is 15.7 actually, and smart money is flowing out of the stock. So it looks like some of these stocks are a little bit out of the favor at the current moment. So with that, let's jump into option chain here and see what we can do. So as you can see here, enterprise product partner, $23 stock. It was 52-week high is 25. It's close to its 52-week high. So you could buy the stock outright by clicking on this, and you pay $23.81 and confirm and send. But if you want to play options game, you could look at options chain here. You could go and delta 70 call option right here. You can pay, as you can see, at $2.33, and you could confirm and send this. And if you do that, you are paying $233. Your max profit is infinite as stock goes up. Your break-even point is 24.33, which is just above the current stock price. So for a stock like Enterprise Product Partners, which doesn't do too much quickly, it's a slow moving stock, you got to be a little careful with the buying option outright. But if the reason is, if the stock stays below 24.33, you tend to lose your entire money, which is not too much. It's $233. But typically with the John Carter's TTM Squeeze indicator, you know stock is going to move either higher or lower. So with that, let's look at a spread strategy here. It's $23 stock or $24 stock. You could do 20-30 spread, which is a $10 spread. So if you do that, you could buy vertical 20-30. There you go. So you pay $3.93. Remaining portion of this $10 is your profit potential. If you confirm and send, you pay $3.93 to make $6.09. It's more than doubling your money, almost tripling your money. I think it's a okay proposition. If the stock stays above 23.93, you tend to make money. But if you're conservative, you could even do it a little differently. And let's see a different way to do this. So right now stock is at 23.90, almost 24. Instead of buying at 20 here, you could go a little lower. You could make it maybe 18 as an example. So if you do 18 on the higher side, you could do 28. So it's a little bit better from a it's a little bit better for entry point and a little more conservative. So if you do that, you are paying, as you can see here, 569. That's the cost of the trade. You're making 431. From a risk reward perspective, it's not as great as the previous one, but as you notice here, your break-even point is below the current stock price now. That's why it's a little bit conservative. You could confirm and send and go from there. But if your account size is a little bit smaller, you could also do a little differently. You could do a $5 wide spread. You could do probably a 21-26 spread. So if you do that, you could go here 21-26. There you go. So you're paying $2.49 and you're almost doubling your money. You're making 251. So you paid 249 to make 251. You are more than doubling your money, and you're doing it with the small cost basis, which is $249 that you're paying right now. So your break-even point is below the current stock price, as you can see here, which is a conservative strategy. So you could confirm and send this. And now let's look at one or two more ideas. So as you scan through this, we got gaps here. It's a 25% below current stock price, and looks like in gap there is a weekly squeeze. You could look at that one too. And as I scan through this, we got a bunch of weekly squeezes here, and we could look at, let's see here, GPK, Howmet, APH, all are I think good ones. And as you scan through further down here, we got a couple more here. Farfetch looks like it's down 36% from 52-week high. It's a good company. Of late, it's been dropping a little bit. Let's look at Farfetch and see if it's worth making a trade here. FTCH. So let's go into squeeze chart here. As you look at Farfetch here, we got a squeeze forming here in the 1-day chart. As you scan through here, shorter term C wave is below 0 and longer term A wave is above 0. At this time, because the line is dark blue, you got to be contrarian to trade this at this point, because there is no clear indicator According to John Carter, if the line is above zero, then you can go on the bullish side, especially the longer term C wave. But here line is above zero barely, so this is where you got to use your conviction and look at a couple other trading indicators to see if it's worth trading. And as you scan through this here, we have no squeeze or a red dot in longer term 3 day, 2 year or weekly chart, or even monthly chart. So with that, to look for a better trade signal, let's go into different chart pattern here and see what's going on. So if you scan through Farfetch here, it's a 1 day, 1 year chart. Chart is pretty, it indicates right now it's a tight trading pattern, as you can imagine. That's where TTM Squeeze indicator comes into play. On the balance, volume says, hey, volume is pretty good. There are people buying this share, which is good to know. And from a RSI perspective, it's 44, so it's a mid-range, and right now it's flat. DMI perspective, right now it's bearish. Red line is above blue line, so that's a little bit bearish, but not wildly bearish, because distance is not great. There is some sign that things might reverse. And as you scan through volatility here, 29.4, volatility is kind of flat at this time. On the balance, check-in money flow is pretty flat. It's trying to go up at this point. So you could, on this one, you could be a little bit contrarian at this time. There is some indication that it might go up, and there's some sign like on the balance volume is telling you, you know what, this is not that bad. So with that, you could jump into option chain here and look at Farfetch, FTCH, and you could buy the stock outright. Currently $47.32. All-time high was $73 and 87 cents in last 52 weeks. And you could go into probably 88 days out, October expiration, and you could buy call option outright, delta 70 or so. 77 is good. As you can see here, you're paying a little bit more money, mainly because as you look through the IV rank here, current IV percentile 29. That's why, because it's little, not too high, little high, still below, well below 50. That's why you're paying a little bit more money. So you could buy a delta 77 call by paying $9.60. And if you do that, your break-even point is 49.60 above the current stock price, and you're paying 960. Your profit is infinite. As stocks goes up or down by $1, your option that you're buying will go up by 77 cents up or down. This is one way to play, but if you're a little bit conservative, you could also do a spread game here. If you want to spread here, current stock price is 47, and as you scan through this, it's all $5 wide spread here. You could do 45.50. That's one way to play. Other way you could do is let's try 45 to 50 here. So if you do that, you're paying $2.28 here, and remaining portion of $5 is your profit potential. You're more than doubling your money. You could confirm and send. You're paying $2.28 to make $2.72. Your break even is just below the current stock price. This is one way to play. You're not spending too much money. You're just spending $228 to make $2.72. It's a conservative play. So if you want to do a little more bigger spread for a bigger profit potential, you could look at here 47. You got 45.50. We already tried this. You'll make some money. You could do 40 and 55. That's a good spread here. You could do 40, 55, $15 wide spread. If you do something along those lines, there you go. You're paying $3.65 here, and your profit potential is 635, a little bit higher, and stock has to go above 48.65 for you to make money. So if you think this stock Farfetch is going to jump, typically this stock does very well during the quarterly earnings. This is a better bet. Only thing to note is really your break-even point is above the current stock price. This is one way to play. Other little more conservative play is to really do 40, basically do 40-50 spread. You could do here 40-50. You're not making too much money. You're almost around doubling your money. It's a $10 wide spread. You're making you're paying 530, you're making 470. So if you do this here, your break-even point, as you can see here, comes little bit below the current stock price. Much more conservative play here. You're paying 530 to make 470, almost doubling your money, but not quite doubling. This is a little more conservative strategy. You could employ this too. Now let's look at one or two more. As we scan through this, we got some stocks highlighted here. I like stocks like Cerner, even EOG is good, Amgen is also good. Coupa has been dropping off late. You could look at some Coupa too, but there is as you can see here, there is a weekly squeeze in Coupa. Now let's look at a couple more here. All great stocks. I like DAQ also here, down 49% from 52-week high. And we got a couple more here, as you can see here. If I were to pick one here, let's look at probably Tulio and see is Tulio worth playing the options game. So if you look at Tulio here, TWLO, and let's go to squeeze chart here. As you can see here, a squeeze is forming the daily chart here. There's a red dot showing the compression. At this time, the Bollinger Bands are inside Keltner channel here. And if you look at the shorter term A wave, it's below zero. There's a red line below zero. But if you look at the longer term A wave, it's squarely above zero, and that's a bullish signal. And as you scan through, we got a squeeze forming the weekly chart, and shorter term A wave is above zero, longer term C wave is above zero. With that, coast is clear here. Twilio can go on the higher side according to John Carter. So we could look at a different chart pattern here and see what's going on. On the balance volume, pretty nice. I like this. And if you see here, RSI is trying to gain some momentum here. I see some uptick here. That's good. And as you scan through here, a DMI chart, the blue line is trying to cross over red line. That's a bullish indicator, mildly bullish. It's trying to cross over. Volatility perspective is 33.1, so indicates you're paying a little bit more money for the options here, mainly because volatility is, as you can see here, it's a little bit increasing, which is still okay. It's below 50. Anytime it's above 45 or 50, you don't want to play just single option because you're paying too much money. But if you're playing a spread, it's okay because you're selling and buying, that will kind of counterbalance. And as you look at the check-in money flow is kind of stable here. So with that, let's look at the option chain and see what we can do. So Twilio here, $374. If you want to buy the stock outright, you could just click on this and buy it at $370. Right now, it's one way to play. But if you want to play the options game, you could, I would say, you could go 186 days or 88 days out. Either way is okay. Typically 186 days is better because it'll give you some more time. So if you do 186 days out, you could look at option price, the stock price here 374. You could go to delta 70, which is around right here. 72 is good enough. You pay $81.05. You could buy this option outright and you'll pay $8,000. And your profit potential is infinite, and your break-even point is higher than the current stock price. Stock has to move at least by $26 or so for you to break even. That's why this is a little bit speculative strategy, unless you know you know what you're doing and you have very good conviction and a good account size. You'd do spread instead. If you just want to be a little more conservative. So if you want to do a spread, you could look at what's going on here. $374 right now, and you could look at 370 range here. So 370, 380, you could do this $10 wide spread. So if you do that here, there you go. So one of the reason, its spread is more attractive in the higher price stocks is, you don't need to pay so much money to buy the stock itself or even the option. Instead, you could look at the slice here. We are doing 370, 380 here, as you can see here. Typically around the current stock price, stock will move higher or lower. So that's why, because the stock movement is really concentrated around the current stock price, that's why many times spread strategy is more attractive. So you're buying a 370 380 spread here, paying 475, $10 wide spread, remaining $5 and 25 cents is your profit potential. You're more than doubling your money. So with that, you could confirm and send this. You're paying, as you can see, 475 to make 525. Your break-even point is just below the current stock price. So this is a little more conservative play, but still, you're doubling your money if the stock goes up with a break-even point of 374. So this is one way to play, and we look at maybe one more here. So I got one more page here, as you can see here. I have not highlighted any here, but you can look through, follow the same methodology. I will quickly look at some of these to see which one we can pick here. I like Inseego also. It's $8 stock. I would say if you want to do Inseego, buy the stock outright, because stock doesn't move that great, but over long term it's a good play with the 5G. And as you scan through here, Church and Wait, that's also okay. We got Designer Brand, that's also okay. And we got a lot of good stocks here. Let me look at next page here, see what's here. So we got some good stocks here also. BJ's down 6% so far. And here we got International, CEDA, Camping World, API, all okay stocks here. And let's look at the last page here. We got a couple more here. Materials, MDLZ, and Arconic, ITT, and so on and so forth. So let's look at previous page. Let's try to pick a stock here and see what we can do. As I scan through here, IV percentile all, 25, low IV percentile. I like that for, option strategies. We got ETR, which is Entergy, down 8%. Berkeley Lights is the biotech stock here. As you can see here, down 61%. We could see if we can do Berkeley Lights, but let's look at BLI and see if it's worth doing any trade. So BLI, $44 stock. If I go to John Carter's chart here, squeeze chart, right now there is a squeeze forming here in the 3-day chart, and as you see here, the shorter term A wave is above zero. It's telling you there is some weakness coming through because the red lines are getting shorter. It might go on the other side on the below zero. And longer term A wave or a C wave, longer term C wave is below zero. Basically, John Carter tells, hey, don't trade this. Even if you want to trade, you want to trade on the short side. Buy some put options or you want to short the stock. So he's not suggesting to go long in this scenario. I would not do long trade here. You could do short trade by buying a put option or a put spread and take it from there. So with that, let me go back here. So in a nutshell, we got a couple pages here of squeeze plays here. You could look at these and see if it makes sense to you and play along. You could even buy the stock outright in these scenarios, or you could do a spread or a buy call option outright. So with that, we got last page here. Thank you very much. Happy investing and trading. Please subscribe.